There's a number following you around right now. You didn't ask for it. Nobody taught you how it works. And it updates constantly based on rules that aren't fully public. And somehow, this number decides whether you can rent an apartment, buy a car, or get a mortgage. Miss it by 20 points and a bank can legally charge you thousands of dollars more in interest over the life of a loan. And the company that invented this number, they also sell a product to help you improve it. That's not a financial system. That's a protection racket with a better logo. I'm talking about the credit score. And by the end of this video, you're going to realize it's one of the most quietly brilliant scams ever invented. Not because it's illegal, but because it isn't. Let's start at the beginning, because the credit score didn't come from the government. It didn't come from banks. It came from an analytics company called Fair Isaac Corporation, founded in 1956. You probably know them better as FICO. And back in the late 1980s, FICO sold lenders on an idea. Instead of having loan officers make gut-feeling decisions on who to lend money to, why not reduce every human being to a single three-digit number? Lenders love this. It was fast, it was scalable, and most importantly, it was defensible in court. If someone didn't get a loan, you could just point at the number. The number said no, not us. The number. So, the FICO score launched in 1989, and it worked so well, in fact, that it became the standard. And that's where things got interesting, because FICO isn't a government agency. It's a private for-profit company, which means the scoring model that determines your financial life is owned by shareholders who have a financial incentive to make sure you keep needing their product. That's not a feature. That's a business model. Now here's where it gets weird, because most people assume the credit score works like a test. Study hard, get a good grade, done. But the credit score isn't really grading how financially responsible you are. It's grading how useful you are to lenders. And those are very different things. Think about it this way. If you pay cash for everything, never borrow money, never use a credit card, and have zero debt, your credit score will be terrible. Not because you're bad with money, but because you're useless to banks. You're a stickman standing in a room full of slot machines with your hands in your pockets. The system has no idea what to do with you. And this is the first thing nobody tells you. A credit score isn't a measure of financial health. It's a measure of how much money banks can make off you. So, how does it actually work? FICO scores range from 300 to 850, calculated using 5 factors. Payment history at 35%, amounts owed at 30%, length of credit history at 15%, new credit at 10%, and credit mix at 10%. Sounds reasonable enough. But the devil is in the details. Because the exact formula FICO uses to calculate your score, it's proprietary, which means it's a secret. The most important number in your financial life is calculated using a formula that nobody outside of FICO is allowed to see. You're being graded on a test and nobody will show you the answer key. And it gets better, because FICO isn't the only score. There's FICO Score 8, FICO Score 9, FICO Score 10, Vantage Score 3.0, Vantage Score 4.0, and dozens of industry-specific models used for auto loans, mortgages, and credit cards. Which means when you check your credit score, the number you see might not even be the number a lender sees. You could have a completely different score depending on which bureau pulls it. Equifax, Experian, and TransUnion all collect their own data, have their own records, and can produce wildly different numbers for the same person, on the same day, for the same human. And here's a fun fact. Around 34% of Americans have found errors on their credit report, errors that can drop your score by 50 to 100 points for no reason whatsoever. And to fix it, you have to file a dispute, wait 30 to 45 days, and pray to whatever financial gods exist that someone actually reviews it. It's the only system in the world where you're guilty until proven innocent, and the burden of proof is entirely on you. So, let's meet Sarah. Sarah is 24, just started her first real job, and decided to finally be an adult about her finances. She checks her score. It's 640. Not great, not terrible. The financial equivalent of a C-. She reads online that she needs to lower her credit utilization. So she pays off her credit card completely. Score goes up. Great. Then she closes an old card she never uses. Score drops 30 points. She had no idea that closing a card hurts the length of her credit history. Then she applies for a new card to rebuild. Another 10-point drop for the hard inquiry. Now she's sitting at 620. She did everything that sounded responsible, and her score got worse. Welcome to the system, Sarah. And this is by design, not because FICO sat in a boardroom cackling like a villain, but because a system with confusing, shifting rules keeps people engaged with the product. Confused people Google solutions. They download apps. They sign up for monitoring services. Which brings us to the best part of this whole thing. The same companies that created your score also sell the tools to fix it. FICO sells score simulators, credit monitoring products, and financial wellness tools. Experian, one of the 3 bureaus that feeds data into your score, runs Experian Boost, a paid subscription that claims to help you improve your score. TransUnion sells credit lock services and identity protection packages. These companies profit directly from you being anxious about the number they invented and control. It's like a pharmaceutical company that manufactures both the disease and the cure. Except, somehow this one is perfectly legal, and nobody seems to mind. So now you understand what the credit score actually is. Not a neutral grading system. A privately owned product, built for lenders, calculated by a secret formula, tracked by companies who profit from your confusion, and applied to decisions that affect almost every major financial moment in your life. But here's the part of the story that doesn't get talked about enough. The downstream effect. Because the credit score doesn't just affect your ability to borrow money, it affects your rent. Landlords run credit checks. It affects your car insurance in most states. Bad credit means higher premiums, even if you've never made a single claim. Some employers run credit checks as part of the hiring process, which means if you had a rough financial patch, a medical emergency, a divorce, a layoff, the system doesn't just make borrowing harder. It can make getting a job harder, which makes improving your finances harder, which keeps your score low, which keeps everything else hard. It's a loop, and it's a beautiful one if you're on the other side of it. Now the data on this is genuinely wild. Around 45 million Americans have no credit score at all, either because they're young, recent immigrants, or they just never played the game. They're called credit invisible. And credit invisibility doesn't just mean you can't get a loan. It means you're locked out of the standard financial system entirely. No mortgage, no apartment lease without a massive upfront deposit, no car financing, not because you're irresponsible, but because you never fed the machine enough data. And on the other end of the spectrum, the people sitting at 800 or above get access to the best rates, best terms, and best products. Not because they're smarter with money, because they've been playing the game longer and understood the rules early. The system doesn't reward the most financially responsible people. It rewards the most financially active ones. Big difference. So here's the big pattern underneath all of this. The credit score was sold to the public as a tool for fairness. One objective number that removes human bias from lending decisions. And, in theory, that sounds great. But in practice, it replaced one set of biases with a different one, because the system still disadvantages people who are younger, lower income, or newer to the country. It still rewards people who already have access to credit. And it's still controlled by private companies who profit from the anxiety it creates. It didn't fix inequality in lending. It automated it and gave it a dashboard. The credit score didn't fix the system. It just made the gatekeeping feel scientific. So, what do you actually do with this? 3 things worth knowing. 1, utilization matters more than most people realize. Keep credit card balances below 30% of your limit, ideally below 10%. 2, never close old accounts unless you have absolutely no choice. The age of your credit history is 15% of your score, and closing cards collapses it overnight. And 3, go check your actual credit report, not your score, at annualcreditreport.com. It's the only federally mandated free report site. Errors are shockingly common, and most people never look, which means most people are being penalized for mistakes they don't even know exist. Because the best thing you can do in a confusing system isn't to opt out. It's to learn the rules faster than they expect you to. And that's the final irony of the credit score. It was designed to be just confusing enough that most people stay anxious, stay engaged, and keep paying for solutions. but it's also just transparent enough that once you actually understand it, you can game it. They built the maze and then sold you the map. The house always has an edge, but at least now you know what game you're playing.